More trade uncertainty as President Trump says auto levies will be announced over the coming days. Now, he also appears to invent a new economic threat, warning of secondary tariffs. Tesla's dismal run in Europe continues with a 40% drop in sales in February. Car makers on the continent also see a broad drop. Plus, HSBC targets growth in Asia and the Middle East after exiting key businesses in Europe and the U.S. We'll have more of our exclusive interview with the Chief Executive, George El-Hadary. Now, first thing is first, let's go to U.S. futures. We've had quite a lot of volatility over the last couple of days. Look, tariffs have definitely been dominating the news flow of this week. U.S. stocks soaring yesterday on signs that trade sanctions will be a little bit more narrow than feared. But now secondary tariffs are a big question mark when it comes to investment. S&P futures down some 0.2%. European stocks, though, seeing a slight lift up. Now, there are a couple of components to that. Now, European stocks are gaining thanks to Shell really lifting the benchmark indices, oil advancing again as President Donald Trump has been threatening to punish any nation purchasing crude from Venezuela with a 25% tariff. We also look at tech and then Bitcoin 86,696. You can see the dollar index 1,272. Now, the other thing we need to watch out for is, of course, the trajectory for Germany going forward. IFO numbers just breaking the Bloomberg terminal. That Germany March IFO business confidence coming in at 86.7, bang in line with expectations. Now, shortly, we'll be speaking to the IFO Institute president, Clemens Fuest, in just a moment. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Trump says some countries will receive breaks from reciprocal tariffs. The comments have sowed more confusion about his plans, which are due to be announced on April 2nd. Now, we'll discuss all of that in a moment with Jari Stehn. He's chief European economist at Goldman Sachs. But first, let's bring in Bloomberg's EMEA news director, Ross Matheson, to talk about the reported Washington messaging breach. Now, The Atlantic's top editor says he was added to a text group where U.S. Defense Secretary Pete Hegseth shared detailed plans for bombing Houthi militants. Well, Jeffrey Goldberg says he received a connection request via the encrypted messaging service Signal from the National Security Advisor, Michael Waltz. Now, a White House spokesperson says the report appears to be authentic and they're reviewing how the journalist was added to the conversation. Whereas this is really what anyone's talking about apart from tariffs. I mean, if this report is true, and it seems that even the White House says, look, this probably happened, it really raises some serious questions.
Well, that's right. The White House is basically acknowledging this happened, but playing down, obviously, the ramifications from it and how, in fact, a journalist could be added to a Signal group for a matter of days and no one seemingly noticed, as they discussed, it appears, quite sensitive information, including classified operative information about planned operations against the Houthis in Yemen, but also, just quite a window again into the operation of the Trump administration, the use of emojis, the debate that went on, the comments about Europe, which at this point shouldn't be a surprise, but showed again the level of the commentary about the relationship with Europe, the disdain for Europe in a way that it seems to come across in these comments, and talking about Europe essentially freeloading and at some point potentially presenting a bill to Europe for helping to patrol the Red Sea and for these airstrikes on the Houthis. But it raises those questions again about the security of information, about the way that stuff's shared. I mean, Signal for a start, which, messages disappear, so you have no record of that. Where were some of these officials potentially when this was happening? Was Witkoff, in fact, in Russia when this was going on? And, again, about what can allies in Europe do from here when it comes to intelligence sharing?
And that's $1 million question. So it goes to intelligence sharing, but also if you're an ally right now, you'd be second guessing what you can do next. I mean, it's the final nail in the coffin of really understanding what the U.S. wants with Europe.
Well, it's with that edict at a company, right? You never write certain memos unless you presume that memo might become public. at some point. So in a lot of your communications, whether it's, phone conversations you would normally think would be private or other interactions, you have to presume that there's a chance that some of that becomes public at some point. But the reality is, even with all of this, that European nations and those who are in what's known as the Five Eyes alliance, including the UK and Australia, they're unlikely to completely pull back from intelligence sharing because they can't, because they get a lot of stuff in turn from the US. So it's very difficult for them to stop intelligence sharing entirely because they're reliant on the US for it. And so unpicking all of that becomes very complicated. But certainly for politicians, heads of state in all their conversations or their cables or their memos, you can imagine them being very, very cautious about what might come from what they would think to be private conversations.
And Jari, I mean, in the context of tariffs, there's just a lot, and this is definitely dominating the news cycle. It's not actionable if you're a market investor, but how do you put that next to tariffs? Is it, is there chaos, or is there a clear, laid out plan, longer term, that the markets needs to understand of what the Trump administration wants to do?
Yeah, I think it's very uncertain at this stage where exactly trade policy is headed. I mean, what has been signaled in the run-up to April 2nd is that every country will be given a tariff number that consists of an existing tariff differential, non-tariff measures, and then potentially some adjustment also for tax differences. But that gives you a pretty wide range in terms of where these initial tariff numbers might come out. Most likely is probably that the numbers initially will be relatively high, then there will be some negotiations, and then ultimately you probably end up with somewhat smaller numbers. That's been the pattern so far. But the uncertainty that's being created by this is obviously important in of itself when we look at confidence, when we look at investment plans and so on.
Okay, thank you both. Bloomberg's Ross Matheson and Jari Stehn from Goldman stay with us. Let's also dive into the latest IFO Institute survey. Let's get straight to Clemens Fuest, president of the IFO Institute. Mr. Fuest, we just had that IFO number pretty much in line with expectations. Look, the German parliament has agreed to this big spending package, and this could be a game changer for Germany, but also these hundreds of billions of euros in infrastructure and defense spend could be a game changer for Europe. Do you think this is what will get Germany unstuck?
Well, I think a lot of work remains to be done, but it's maybe a first step. The IFO reading today maybe also reflects the mere fact that we do have a chance to get a stable government. There's a lot of fragmentation, political fragmentation in Germany as well as in other countries, and there was some relief when the results of the elections were such that yes, there is a chance to have a stable government, a coalition of the Social Democrats with the Conservatives. Now, this spending plan is a big change. It will have to be complemented with other types of reform. If not, it will maybe have primarily affect inflation. The question is, for instance, if we look at the construction industry, building infrastructure, it is running at full capacity at the moment. So there are concerns that the more money thrown at them will raise prices. We need reforms that encourage companies to build up capacity. We need a simplification of planning permissions. And it is only with these complementary reforms that we will get an effect on infrastructure spending. So there's more work to be done, but the spending package is certainly a first step.
So are you hearing the right signals actually from the government that these extra measures will take place with the money to make sure that it gives, again, the economy the biggest possible impact?
Well, I guess that's the issue at the moment. So what comes out of the coalition negotiations is that there is a lot of disagreement on fiscal policy, on deregulation, and it's not clear how this will play out. The first result is that the coalition negotiations will take longer than anticipated. And I would expect that in the end, the parties will agree on something, but it will probably not be a very ambitious reform package. And that's the challenge. At least maybe in the field of planning permissions, this is not so controversial. Maybe there will be some movement there, but this whole package will remain a challenge.
Yeah, a challenge, but overall, I guess, a positive. At the same time, what are companies saying about these new tariffs coming into place? Is it a net positive, a net minus that kind of cancels each other out if you look at the defense spending, the infrastructure spending, but then this fragmentation of trade?
It's interesting that we see little movement in our survey in the sectors where you would expect movement, maybe. If you look at the construction industry, especially the part of construction industry out of residential buildings, so building infrastructure, there isn't very much movement here in the survey, so companies seem to remain skeptical there. At the same time, there is no collapse of export expectations, so the fear of new tariffs doesn't seem to be very large, or maybe it hasn't changed very much. And I guess that's related to the fact that Trump has been very volatile, announcing tariffs, then taking them back. I mean, there is a basic concern about U.S. trade policy, of course, but we haven't seen major changes in these concerns, at least in this survey during the last month. That may change when the Trump administration actually publishes its plans announced for next week, but currently we don't see much in the survey.
Okay, Mr. Fuest, thank you so much. The IFO Institute president there, Clemens. Fuest, still with us, Ros Matheson and Jari Stehn. Jari, I mean, we're talking a little bit about the tariffs, and, you know, I'll ask Ros in a second. There's so much confusion about these tariffs. We don't exactly know. I don't exactly know what's coming on April 2nd. But what does it mean for the European economy? It makes it more complicated for the ECB. It makes it more complicated for also a lot of the measures that governments are putting in place.
Yeah, for sure. I would say the framework we've been using is to distinguish really between targeted tariffs and broad-based tariffs. So I think as long as the tariffs remain more targeted, so focused on individual sectors, then we think overall from a macro perspective it's a significant negative, but it's manageable. But of course, once these tariffs become targeted across the board, or if, for example, the VAT adjustment will be part of the tariff announcement, then of course it becomes a much more broad-based challenge. So the numbers that we have are roughly a 0.5 point hit to GDP if it's targeted tariffs, which is our base case, and then 1 or even 1.5% of a hit to GDP when they become more broad-based. So you can see that the numbers are both negative, but the broad-based tariffs are really the ones to worry about. Now when you get to the ECB, there's of course also a price effect that if you have tariffs and you retaliate against them, you push up inflation. But I think quite importantly, it's a pretty mechanical effect. It's a one-off effect on prices. And so when you look at weaker growth and only a one-time effect on inflation, we ultimately think it's not something the ECB should really worry about. And that's why we think they will cut in April, despite a pretty non-committal messaging out of the ECB.
And Ros, I guess the biggest concern is, we kind of know what's coming April 2nd, but then it could change very quickly. Right. So do you have any insight into the Trump administration thinking? It's almost like they're muddying the waters because it gives them power to negotiate better.
Well, that's right, because he does like to keep things in the back pocket because, above all, he's a businessman and he likes to keep people, companies, other leaders on their toes, and he likes to negotiate. I mean, we see he seems to have invented a new thing overnight, which is secondary tariffs, which is probably his version of secondary sanctions, but he doesn't really like sanctions, so he's going to call them tariffs. But that shows, again, how he's using all of this really as a political tool and a negotiating tool. So he'll penalise countries that import oil from Venezuela as a secondary tariff. So again, what he likes to do is keep the chessboard moving all the time, and that's why we will still see, even after April 2nd, probably a lot of uncertainty, because he's flagging now sectoral tariffs on autos maybe before April 2nd, maybe after, but still chips, the pharmaceutical sector, those are all things he says are still to come, and he's going to use tariffs very much as a weapon for politics against individual countries or groups of countries. And so this is just the environment we're in, and it means that for companies and for economies, they've got to adapt to that.
Ros, the other question, and I imagine that one of his big pillars is trying to get cheaper energy, including cheaper oil, is actually what's happening in these Russia-U.S. talks on Ukraine. Are we closer to something?
Well, they had very, very long talks yesterday, and we understand that the US officials are back talking with Ukraine officials again this morning, so they seem to be pushing towards something. We know these conversations were very technical. Yesterday focused very much on the Black Sea and maritime traffic, so probably some arrangements around that, to your point about making sure that everything can leave Ukraine, including grain potentially also, which is important for a lot of regions around the world. And so can you get certainty around trade and maritime traffic, whether it's going to extend to something broader than that, or it's a bit of a sort of Lego ceasefire where you're stacking ceasefires on top of each other again, and you get the energy arrangement, then you get the Black Sea, then you get something in terms of the situation on the ground inside Ukraine with territory. So it's a bit by bit move, but we are expecting some kind of statement from the US and Russia collectively at some point today, and it seems they are gearing up to announce something, but it's probably more around the Black Sea.
And Jari, how should we look at the energy complex for Europe? Again, if you look at inflation pressures and the fact that we still don't know whether tariffs hurt growth more than they bring up inflation, how should we look at the price of oil?
Yeah, I mean, this is one area where over the last few weeks there's, of course, been some relief for Europe. I mean, oil a little bit, but mainly gas. Yeah. So when you look, for example, at the cutoff point for the ECB staff projections in March and what has happened since then, a weighted average of oil and gas is down almost 15%. So I think it does help in terms of the inflation outlook. Mm-hmm. We, of course, have also seen some appreciation of the euro recently that, again, helps you with the inflation outlook. And so we do think that despite all this uncertainty around trade, that we are on track in terms of the inflation picture to converge to 2%. And I think the ECB can take comfort from that despite all these uncertainties that we're talking about.
Okay, thank you both. Our Bloomberg EMEA News Director, Ross Matheson, and Jari Stehn stays with us. We'll also talk, of course, about the spring statement. Coming up, Donald Trump says he'll announce tariffs on autos in the coming days. We'll examine the potential impact on Europe's car industry. That's next, and this is Bloomberg. Welcome back, everyone. European auto stocks higher this morning, brushing off President Trump saying he'll announce tariffs on autos in the coming days. Well, still with us, Jari Stehn, Goldman Sachs' chief European economist, and we're joined by Craig Trudell, who leads Bloomberg's global autos coverage. So thank you both for either sticking around or joining us. Craig, cars, I mean, are they going to be really in the firing line of the Trump administration?
I think, if we go off of what he's been saying consistently, not just for years, but for decades, it's been that, when he talks about trade and when he talks about the way the U.S. is treated even by, countries that we would consider U.S. allies, that he strongly views cars as being a sort of front and center example of the ways in which there are inequities and how U.S. cars are treated relative to other countries. Now, is there nuance to that? Is there reasons that U.S. cars aren't desired elsewhere in the world?
I was going to ask you.
Important question.
I mean, it's true. I mean, there are not that many Fords, right?
Correct.
I mean, maybe there are a couple of Ford Mustangs, which is a good-looking car, but there's just not that many, cars driving through European cities. Is it the size or is it regulation?
I think size, regulation. I think importantly, a lot of the Fords that you do see here in Europe are made here in Europe. So what need is there for Ford to import into European countries? And you have GM, the biggest U.S. car maker, essentially absent from Europe, right? They pulled out years ago when they sold Opel and Vauxhall. So you have these sort of structural, issues where, there's not really a sort of way in which Europe can sort of answer his criticisms by saying, sure, we'll open up when the companies aren't even trying, in the case of GM.
Yeah, how much do you look at, Jari, car makers, frankly, have had a dismal run, full stop, in Europe for a number of reasons. How much do you look at the car makers and manufacturing sector as, I guess, a benchmark or a blueprint of what Europe needs to do to fix it overall?
Yeah, I mean, I think it's clearly been under pressure in the firing line for a while. I think you've kind of seen both cyclical effects, but also structural forces, headwinds. I mean, the auto tariffs obviously would be another negative on top of that. But I would also say it's pretty widely expected at this point. I would also say, reiterate a point made earlier that a lot of the production of German cars is actually in the US to the US market and so on. So you kind of need to take all that into account. And the macro effects, I think, of these car tariffs are clearly negative, but not as big as some of those broader uncertainty effects we talked about earlier. I would mention one other point that I think is interesting in conjunction with the German fiscal package, which of course is raising spending massively, as we heard earlier. And there's a big question around capacity. Does the German economy actually have the capacity? And one sector where there clearly is capacity is in manufacturing and in cars. And so I think that's going to be an interesting question for the next couple of years, to what extent Germany can kind of repurpose some of the spare auto capacity into other sectors, into defense, into sort of other manufacturing goods.
Craig, I'm looking at Tesla. Why is it doing so badly in Europe?
I think, people jump to Elon's politics potentially being at play here. I think we're going to find out in the next few months just how much that is having a real impact and how much of this has been a really important changeover that they have within their lineup. The Model Y was in need of a bit of refreshing. It debuted back in 2020. They've redesigned it, and that was going to cost them weeks of production in the first quarter. And it takes time, of course, once you've done that changeover for that production to ramp back up. So really dismal start to the year for the company in Europe and honestly globally. I think the first quarter numbers, there's real concern about that report coming next week from the company, just how bad the numbers are going to be. I
also wanted to really focus on the UK because of the spring statement, but I don't know whether there's a difference in terms of car usage in the UK compared to the rest of Europe. But spring statement, of course, tomorrow. It's quite exciting to see the changes that the Chancellor may or may not put in place. Does she restore her fiscal headroom? I mean, does she have any other choice, frankly?
So I think the spring statement really is about the updated OBR projections and then how the Chancellor responds to that to restore headroom. So the updated projections are likely to show pre-measure somewhat negative headroom, mainly because interest rates have gone up since October. And then the Chancellor is expected to respond to that by trimming some of the spending commitments. So I think the comments imply it's very unlikely that she's going to change either the fiscal rules or raise taxes for this event. So the signaling has been in the direction of some welfare spending cuts, some departmental spending cuts to the tune of 10 to 15 billion, which would then roughly restore the headroom, the pretty small headroom, but the headroom that we had in October. So I think that's quite likely for tomorrow. But in some ways, the bigger question is, of course, where we're headed for the rest of the year and into the budget in October and what the fiscal pressures are going to be for the rest of the year.
I mean, how does this country grow, I think, is the ultimate question that, investors will want to know. Is there a clear blueprint from the government reducing some of the planning, even reducing regulation, that you think will really kickstart the UK?
Yeah, I think in the near term, what will be important will be to get lower interest rates coming through. So I think a priority at this stage is not to jeopardize Bank of England rate cuts by, for example, raising taxes that could have inflationary effects. So I think that could give you a little bit of leverage in terms of growth over the next few quarters if the Bank of England does cut as we expect them to do. But longer term, obviously, the productivity growth statistics are poor. I think two areas that the government has talked about are planning reform, as you mentioned. I mean, there's the mechanical effect of building more houses that helps GDP. But actually, the more interesting effect is if you allow workers to move towards big cities where productivity levels are higher. So you want to try to create scale effects and boost productivity growth that way. So I think that's one interesting initiative. And then the other one is, of course, around trade, closer trading relationship with Europe, where most estimates would suggest you can get some productivity lift from that over the coming years. So I think those are the two longer-term initiatives to focus on.
And Craig, I mean, if you look at, the buying of Teslas as a benchmark of wealth, are the Brits buying new EVs?
I do think it's interesting. I mentioned, Musk's politics, and of course he's inserted himself both in Westminster and in Berlin, right? And it has been interesting to see, in the early goings of this year, they've actually had a bit better of a time here in the UK versus Germany, and it's been pretty dramatic. Where in Germany we've seen 70+% declines versus relatively moderate gains here in the UK. That may have something to do with the fact that they are highly reliant on Chinese production for this market and maybe had some inventory to work with earlier this year.
So interesting. Thank you both for joining us. Jari Stehn, Goldman Sachs' chief European economist and Bloomberg's global autos editor. We like calling him the auto tsar, Craig Trudell. Coming up, we'll be joined by Rishi Khosla, co-founder and chief executive of Oaknorth Bank. We discuss the fintech environment ahead of the UK spring statement. We'll also talk about loans and some of the tariffs, what kind of impact he sees for the companies they service. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top headlines. More trade uncertainty as President Trump says auto levies will be announced over the coming days. Now, he also appears to invent a new economic threat, warning of secondary tariffs. Tesla's dismal run in Europe continues with a 40% drop in sales in February. Car makers on the continent also see a broad drop. Plus, HSBC targets growth in Asia and the Middle East after exiting key businesses in Europe. And the U.S. will have more of our exclusive interview with the chief executive, Georges El-Hadary. Now, it's also crunch time for Rachel Reeves as she's set to announce billions of pounds of spending cuts in her spring statement on Wednesday. Now, it will be a make-or-break moment for the Chancellor, who had promised stable public finances and a single major fiscal event a year. For more on this, we're joined by Philip Aldrich, Bloomberg's senior UK economy reporter. So thank you, Phil, for joining us. I feel like every time you say make or break, it's make or break. But actually, this is going to be a quite delicate one because she promised cuts, which she probably can't deliver.
Yeah, it's a tricky one. Obviously, she's going to supposedly make about £10 billion of cuts. Some of it will probably be done within the spending review envelope. Some of it will be in the final year, which is always being characterised as a fiscal fiction because these don't have to be sort of costed into departmental spending plans. But some cuts, I think, will be taken off the envelope and be real. And so departments are going to feel it. And obviously, you're already getting a backlash from Labour MPs about the welfare cuts. We're going to see spending cuts in some unprotected departments in particular. There's likely to be more complaints about that.
Yeah, so, I mean, she's facing pressure, frankly, from all sides, right? The public, MPs, millionaires or billionaires. Like, how is she going to land the plane?
Well, I think that there's one constituency which they've become really focused on, and that is Bloomberg's sort of core client base. It's the markets, right? Everything went a bit wrong back in October because she left herself so little headroom. There was no insurance against any sort of changes in market interest rates or any changes in the sort of economic outlook, and that has basically been the sort of backdrop to a lot of the problems since. So one of the key things she's going to do is restore the headroom because she's lost about 15 billion. She's at -5 is where she starts, having been at plus 10 billion pounds in the October budget against her fiscal rules. She is going to, we think, going to restore that headroom, which will provide some reassurance to investors that she is focusing on this economic stability that she says all of the growth plans that they have are built upon. So I mean that's basically the bedrock for what they're going to be announcing next week to try and rebuild confidence in their plans.
Yeah, so because the spending review is the big one. I mean, there's so many, like, what is actually the biggest for her? There's the OBR, there's spring statement, and the spending review.
Well, I guess this is the biggest immediate issue because the OBR is going to cut the growth outlook. It's going to show that she did make a mistake back in October at the budget, and there is potentially going to be a warning that this is just a prelude to even worse forecasts that, in the autumn budget. The OBR has got this heroic assumption about productivity. Should they downgrade their productivity forecast, it will blow a hole in her numbers, come October, November time again. So, this really is the key event. The spending review is going to be ugly politically because it's at that point that you start to identify who's going to bear the burden of the cuts, and then people will really see what's coming through in public services. But in the meantime, there's also the details of the welfare cuts that they outlined last week, where we'll identify how many people and who are going to lose these benefits. And so Labour they're not elected to make people poorer, but the accusations are already coming out that they're going to leave some people who are already poor worse off.
Yeah, it's going to be a definitely bumpy ride politically for them. Thank you so much, Phil Aldrich, there, our senior UK economy reporter. Now, a reminder that we'll also have special coverage of the Chancellor's spring statement from 12:30 p.m. London time, March 26 tomorrow. Let's also discuss the UK's fintech environment ahead of the spring budget. My next guest is a co-founder and chief executive of Oaknorth Bank, a digital business bank for entrepreneurs. Now, as Labour tries to revive London's struggling listing market, Oaknorth has recently expanded its U.S. presence by acquiring a Michigan-based bank. Well, Chief Executive Rishi Khosla joins us now. Rishi, thank you so much for joining us. Now, first, I want to start about the UK, and then I want to ask you why you're so attracted by the U.S. lending market. But I mean, are you frustrated with the UK market? We have a new government in place. There's been a bit of up and down. There's a threat of tariffs. It doesn't look like it's a pretty picture.
So look, we set up Oaknorth really to help entrepreneurs, right, starting here in the UK. Over the last 9.5 years, we've helped create something like 56,000 new jobs through the lending that we've done to entrepreneurs in the UK. I think fundamentally the way to have a positive environment in the UK is to have growth. The best way to have growth is to have the human capital which drives growth, i.e. the entrepreneurs, right? So creating an environment which is very fertile to actually attract global entrepreneurs to come and set up in the UK, in various cities in the UK, in the same way that you have almost a dozen cities around the world which are setting up their stall to attract those entrepreneurs. I think that's what the UK needs to do much more of. It needs to lean significantly more into that contingent, and again, very specifically, I would call out those growth entrepreneurs versus the CEOs of big PLC type multinational companies, because their level of productivity gains that they give when they come in and invest is significantly smaller, although the dollars may be larger.
But Rishi, I mean, this is a problem, is that actually there was so much in the autumn statement from the government that it's unclear whether they're entrepreneur friendly or not. They're trying to do things like, cutting planning, making things quicker, trying to revive growth, even, putting pension funds to put more money in UK companies, the smaller UK companies. At the same time, they increase NICs. So do you think they're business friendly?
I mean, overall, you come out of the autumn statement and it's hard to say they're business friendly, right? I mean, absolutely trying to unlock the pension money to come into private companies, great. But over what period? Over 3, 4, 5 years? I mean, the challenge in terms of some of the measures from the autumn statement is that you cause an exodus of entrepreneurs out of the country, right? And you're telling global entrepreneurs that the UK is somewhat indifferent, right, or arguably even worse, to actually attracting you to come and establish your businesses here or grow your businesses here. Whereas I think we know what we need to be doing exactly the opposite. And, I'm forever the optimist, so maybe there's something tomorrow.
But do you think, I mean, again, have you seen an exodus of entrepreneurs saying, look, I'm going to look for capital elsewhere, I'm going to be... I mean, is it easier
100%.
to do business in the US?
There are so many cities, again, I specifically call out cities versus countries, cities which are setting up stall, right, to attract those entrepreneurs, and whether that's Milan, whether that's Abu Dhabi, whether that's Singapore, whether that's various US cities, New York, Miami, etc., Austin. Like, there is a lot of incentives and effort going in by those cities to attract those entrepreneurs. And do we see them leaving from the UK? I mean, the stats, I think, which are shared from Henley and Partners, at least, shows that the UK had the largest loss of millionaires after China. And obviously, we're sort of, a 20th of the population, if not less, of China. So that's a pretty stark stat.
Rishi, does that hurt how much does that hurt your business actually in the UK? I know you're also looking at, but listings. What would it take for you to list here?
So look, we continue to grow here in the UK. We continue to support British entrepreneurs, right? In terms of overall size of our business today, compared to market size, we're less than 1% of the market. So our ability to continue to grow, and there will always be great entrepreneurs to support, and we're there to support them. So does it hurt the business? I would say it doesn't hurt the business. We continue. And yes, we are expanding in the US, right? And we have been over the last 2 years or so. And that continues to go incredibly well. In terms of listing, Who knows?
Who knows? Very diplomatically put, you recently acquired Community Unity Bank. This is a U.S. bank with a license. Why buy a bank with a license instead of looking for your own U.S. license?
So number one, we signed the deal subject to regulatory approvals. Okay. So closing will be whenever we go through, get past the regulatory approval process. Why buy a U.S. bank rather than go through a de novo process? Fundamentally, we found a relatively small bank which had an excellent team, which had already gone through the process and had just a very aligned culture and view of the world, and therefore that acts as a small springboard to our plans. Fundamentally, I think the assimilation of that team into our culture is one which is going to be easy and therefore very logical.
Rishi, what's drawing you to the U.S. market right now, given these tariffs and some of the uncertainty surrounding the U.S. market globally, I have to say, but also the U.S. market?
I was going to say, look, we started the business since September 2015. There's only been uncertainty, like obviously with Brexit in the UK and then all the way through to today. So living in an uncertain environment, I think, is just the new norm. And fundamentally, if you look at the US market, it's over $4 trillion versus like $500 billion in the UK for us. So in terms of just general market size, it makes sense to play that. And also the US has evolved in terms of moving away from pure bank funding. And as Oaknorth, combining private credit, fintech and commercial banking elements for our customer base, it's sort of the US is a market which already accepts alternative finances, so ultimately a great place for us to expand.
How much do you want to grow in the US?
A lot.
What's a lot?
I mean, look, we've been, if you look over the last several years, the business has been growing about over 20% a year very consistently. Yeah. Right, I think our baseline is to continue that growth profile over the next years. Obviously, that means much higher growth in the US comparatively off a smaller base. So continuing that overall trajectory.
But is it because you actually found a gap in the offering, or is it because you just think the pie will grow for everyone?
There's absolutely a gap. The whole idea behind setting up Oaknorth was the fact that banks generally focus very well on either retail customers and consumer customers and micro businesses and or large businesses. And in the middle, you get this whole contingent which just gets, in a way, underserved, overlooked. And it's that market, the lower middle market, the missing middle, which is our core focus. And that's the same in the UK, it's the same in the US, it's the same in pretty much every market. So there is a gap, and ultimately that gap, in our view, is the highest productivity element of any economy, because that's where the growth businesses are.
Yeah, I mean, again, in the middle of tariffs, it's not an obvious choice, right? It's a brave choice, I would say.
Setting up the third new bank in 150 years in the UK was a relatively brave choice. So,
what surprised you the most since you set it up?
It's just been the ease of actually getting into the market and the velocity under which we've been able to build. So we're already about 3 times the original plan that we expected in the US. So just the velocity of activity in the US is just very significant, even in environments which are bumpy. Like just the entrepreneurial spirit, those animal spirits are just so strong.
I know you won't say much, but are you thinking about IPOing, or is it not, one of your priorities at the moment?
Look, the last time we raised equity capital was 6 years ago. We've been profitably funding our growth ever since, and really since we started the business. So it's not an imperative.
And the markets is volatile. I mean, does that come into your thinking, or also your clients' thinking?
I mean, look, the way the public markets have evolved over the last decade has just been relatively adverse for issuers, right, if you compare it with where it was. So if you look at liquidity, if you look at sort of passive versus active, et cetera, you look at the volatility levels, you sort of say, if you need to, it makes sense. But ultimately, if there's a choice, you evaluate options.
Yeah, and it feels like private companies actually have been doing okay. I don't know whether, again, that conversation has changed over the last couple of years for you.
I mean, ultimately, being a private company, I think, has a lot of benefits. Again, if you're a consumer-facing business and being public actually gives you a massive branding uplift, or if you're a continuous issuer, you need to continue to fundraise. Totally different. The capital markets actually work extremely well. But actually, if you don't have those dynamics, being private actually takes away a lot of noise.
Rishi, thank you so much for joining us today. That was Rishi Khosla there, the co-founder and chief executive of Oaknorth Bank. Now, the chief executive of HSBC has told Bloomberg that he plans to double down on investment bank operations in Asia and the Middle East after exiting key businesses in Europe and the U.S. Well, Georges Elideri says a restructuring will save $1.5 billion. We spoke to him exclusively at the bank's Global Investment Summit in Hong Kong.
So what we announced is we will be incurring about $1.8 billion of cost, essentially severance cost.
Okay.
That the saving, most of the decisioning for that will take place this year. Most of it will take place in the first half of the year. That the benefits will start materializing this year, where the $300 million benefit will come this year. That the benefits will materialize in full by the end of full year 2026. So the full year 2027 will benefit from the full $1.5 billion saves that we're targeting. What we also committed that these will be permanent saves going forward, and that we're taking these saves straight to the bottom line. So it's a payback period of effectively roughly 2 years, but it's a permanent benefit that we will achieve.
And then the other component there is a further $1.5 billion, which I was looking at your earnings statement, and it was page 11 or 12, I think, of the strategic review. And the way you phrase it there is a reallocation of those costs into growth businesses. So I think it's a two-part question I have is, if you're reallocating costs, is that a net savings? Is $1.5 billion net savings? And what exactly are you looking at doing? Because there's not a lot of detail on that.
Yeah. So the organizational simplification benefits, which are efficiency saves, not impacting revenue in any material shape, $1.5 billion, those will be taken to the bottom line. That's the first $1.5 billion.
Yes.
Now, additionally to that, we're also looking at the what we do and recognize that there are further focus that we can achieve in our business, where we will be taking $1.5 billion from activities that we are currently doing that are either non-strategic or non-returning, and we will reallocate these $1.5 billion as we materialize the saves. We reallocate them back into areas where we have competitive strength, where our customers expect us and need us to be, where we can generate good returns, and where we have greatest opportunities to grow. This second $1.5 billion, the revenue we will lose against it because we will be stopping activities.
Those units, those assets, yeah.
Those assets. We expect to be able to generate better quality revenue instead, because they're more strategic or higher returning.
And have you told your team, have you given a timeline for that second tranche of?
Yeah, we expect to do it in the medium term, but there are a number of these initiatives which we already communicated to the market. For instance, about $300 million of this $1.5 billion will be delivered through our decisions around investment banking, in particular M&A and ECM, in Europe and in Americas, where we're basically scaling down this activity. And others will come from other inorganic activities, such as the sale of our German private bank business, the sale of our French insurance business, Bahrain retail business, etc.
Looking at the timing of perhaps, and I know it's under review, so I'm not sure how much detail you could give at this point in time, but you mentioned a lot of those decisions will be made over the next few months. And correct me if I'm wrong, I think the timeline you gave was you want to complete the review by June of this year. When do you think you'll be able to make meaningful announcements?
So with regards the efficiency saves, most of the announcements are done. The rest is execution. We will be able to talk to how much we've decisioned. But again, we have committed to achieve these saves by the end of full year 2026. So we're working on that timeline.
Right.
With regard to the reallocation of costs from non-strategic or low-returning areas to strategic, areas of stronger competitive advantages and higher growth prospects, and obviously higher return prospects, we will announce as and when we have something to announce. So as I said, I've shared with you some of the ones that we've gone public with, and then the rest, as and when we're ready to announce, we will make it public.
I mean, suffice to say then you're happy with your footprint, or if not looking to increase your footprint here?
Absolutely happy with our footprint.
What about investment banking in Asia Pacific?
Absolutely happy with our investment banking in Asia Pacific. Look, for the investment bank, we obviously want to double down on all our capability around debt, That's debt capital markets, leverage acquisition finance, and other financing activities, because that's the heart of everything we do globally. And in regards Asia and the Middle East, we want to also double down our capabilities in M&A and ECM. So the exit that we're processing now in Europe and the Americas is to allow us to focus at the areas where we can really be differentiating to our customers, where we play to our competitive strength, and where we really bring value.
Well, that was the HSBC Chief Executive, George El-Hedary, speaking exclusively with Bloomberg's David Ingles. Coming up, how Google is reshaping its search engine around AI in the face of competition from ChatGPT. We'll have more on today's Big Take next. This is Bloomberg. This is a Pulse, and you're looking live at the Principal Room. Coming up later today, we'll be speaking to the Chief Executive Officer of Shell, Wael Sawan. That's at 3 p.m. Eastern, 7 p.m. in London. And this is Bloomberg.
Wednesday, UK Chancellor Rachel Reeves delivers the government's spring statement. How will she fix the hole in the UK's finances after her fiscal headroom was all but wiped out? And will she be able to keep her own fiscal rules? Live from Westminster, Bloomberg Television has special coverage, starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. Bloomberg. Context changes everything.
Now, the Airbus Chief Executive Officer, Guillaume, says any potential tariffs between the U.S. and Europe could be more problematic for the plane maker's rival, Boeing. Now, Airbus's main factories are globally more spread out than Boeing's, which only assembles aircraft in the U.S. Now, in an exclusive interview with Guy Johnson, Faury added that he's encouraged there hasn't yet been talk of aviation-related tariffs.
No, we keep doing what we've been doing so far, relying on Alabama, indeed. Yeah. That's a plant where we have 3 final assembly lines. One is not yet delivering planes, but the 2 others are. So we are procuring from everywhere around the world, assembling there in the US with US jobs, 2 US airlines as well. So I think we are key to the US ecosystem, to the aviation ecosystem, and we think that plays a big role in how tariffs are targeted.
Well, that was the Airbus Chief Executive, Guillaume Faury. Now, today's Big Take looks at how Google is reshaping its search around AI as it seeks an answer to rivals like ChatGPT. Google search has dominated the web for more than 2 decades, but is now being challenged by advances in AI. Well, let's get more with Bloomberg's technology editor, Olivia Solon. Olivia, thank you so much for joining us. So how is Google's core search product evolving in response to the rise of AI chatbots?
Slowly, I think, is the quick answer. It looks like Google's been talking about shifting its search to more of an AI chatbot style model for years, even before the launch of ChatGPT. But there's been a lot of internal resistance for various reasons. Search is the company's cash cow, so management's been reluctant to do anything to disrupt that. But last year, with OpenAI and others snapping at its heels, Google appointed a new lead for search, a woman called Elizabeth Reed, and she's been really shaking things up. And so that's why you're now starting to see things like AI overviews and chatbot-based search.
So, Olivia, what does that mean for its advertising-based business model?
Right. Well, Google, as you know, makes most of its money from companies paying to place their ads against organic search results. I think it's about 60% or 200 billion of its annual revenue comes from that. So if you're delivering the answer, like in an AI form of an answer, instead of a whole page full of links, you lose that screen real estate that you were using to place ads. And you also lose that attention of the people spending time clicking in and out of links trying to find the answers to their questions. And the only way to compensate for that is to charge for an AI-enhanced version of something that people kind of expected to be free.
But so how about publishers who have designed their sites for Google discoverability?
Well, AI overviews and sort of chatbot-style search
effectively hijack the content from publishers so people don't have to click through to their websites. Most websites rely on that traffic for ad revenue and subscriptions, so they're understandably not all that happy about that and have seen that traffic massively drop off. And without that traffic, there's a kind of less of an incentive for those publishers to make high quality content if Google's just going to repackage it and serve it directly. And so this could mean a further deterioration of the overall information ecosystem that's ultimately used to train the AI models that deliver those chat-based search results.
And Olivia, the chairman of Alibaba has warned of an AI data center bubble. Is there one?
Well, he certainly thinks so. He's saying there's been a rush to finance and build out data centers for AI without really seeing the customers secured. And we've certainly seen these huge capex spends from companies like Amazon, Alphabet, and Microsoft, who are allocating hundreds of millions of dollars together to build digital infrastructure. And this is all while everyone's still kind of figuring out the real practical utility of some of these new AI tools. And then at the same time, we're seeing companies like China's DeepSeek launching AI models that claim to use a fraction of the compute power to train them. And so there are sort of further questions, first of all, about the utility of AI in the first place, and secondly, about whether it even needs all of that compute power at all.
Okay, Olivia, thanks so much. Bloomberg's technology editor, Olivia Sala. Now, later on Bloomberg, we'll also be speaking to the Shell CEO, Wael Sawan. That's at 7 p.m. London time. Now, this is the picture overall for markets. A lot of the focus, of course, on tariffs and what is happening there. Shell also giving a bit of a lift to a lot of these commodity stocks in Europe. Up next, to Bloomberg surveillance. This is Bloomberg.